Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we're going to make the best investments that we can. So thank you so much for joining us. And on today's show, we have Joe Springer, and today Joe's going to tell us about, according to him, why we are not on the cusp of a major market crash. He's going to tell us why small caps are his preferred hunting ground and what specifically he looks for when he screens for his small cap investments. He tells us how he researches and how he decides on the companies that he ultimately puts in his portfolio. And he tells us what small cap sectors, according to him, right now offer the greatest value. And as always, our goal here is to help you learn to invest. That's financially and in all of life. You can always find more at investorinthefamily.com. And I want to thank everyone who signed up or applied for the Investor in the Family, the Intelligent Investor Reading Club that I talked about last week. We will have results soon as far as who made the cut, or I should say who's going to be in the club. That makes it sound a little bit too competitive, but very excited and thankful for everyone who applied, and looking forward to making that happen. If you are an avid listener of Investor in the Family Radio looking for a way to support the show, remember you can support us whenever you shop at Amazon. Instead of going to Amazon.com, go to investorinthefamily.com/Amazon. You'll be redirected right back to the normal Amazon site. Everything will be normal for you and no extra cost at all, but a small commission will come back to us as a way of saying thank you. So I hope you enjoy today's show with Joe Springer. Well, hey, Joe, welcome to the show.
Hey, Brian, thanks for having me.
Man, well, I'm excited to have you here, and I'd love if we could get started. Do you mind just sharing a little bit about your background as an investor and what you're doing now as well?
Sure. My background as an investor is I'm self-taught, and I just took an interest in investing. Investing is fascinating, as you well know, and just from reading a lot, including on Seeking Alpha, but reading guys like Joel Greenblatt, Bruce Greenwald is probably one of my favorites. He's maybe one of the guys that is one of the most successful and one of the smartest, in my opinion, that is perhaps not all that well known. But with Bruce Greenwald, I really felt like reading all his stuff. He's the head of the guy at Columbia's Graham and Dodd Value Investing. So anyway, you can see all his courses for free online. I went through all his courses. I read just about everything I could, and eventually I started getting my stuff published on Seeking Alpha, and eventually it started getting my name out there. And so just being intrigued with the market and in this internet age where all the information's out there for us, and just being fascinated with it, I sort of caught on.
So are you a professional investor now, or are you mostly self-directed on the side?
I do a little bit of both. I've got friends and family mostly, but I don't charge them. And so they're always picking my brain. And then,
sure.
Yep. And on Seeking Alpha, I do the newsletter there. I think the next move for me may be to start my own investing business. I think that might be the next step.
Great. Well, yeah. Tell me more. So how you said you're self-taught, and at what point did investing become the fascination that you say it is now?
Well, even as a kid, I don't know if you ever heard of Penny Power. I used to subscribe to that magazine. Money is endlessly fascinating. But I got to say, really, 2000, I was working for a company called Ridex Series Funds. And a lot of times they were in the papers as being the top moving funds because they had leveraged funds before anybody else. And so I went there when the market was just booming in 2000. And then I was there in 2000 also when the market tanked. And then I saw it again in 2007, 2008. And that time there, 2007, 2008, was like, hey, this is a huge opportunity. I've seen this before. And I think that was the time when I really decided I wanted to pivot into finance full time.
So basically, after your experience in 2000, you realized, okay, this is rough, but you knew it was going to create a lot of incredible unfortunately not once in a lifetime, but really unique buying opportunities.
Right, not once in a lifetime. Yeah. Well, to me at the time, it was so new. I really had no background. I've got a degree in philosophy. I had no background at the time in finance. Yeah. So 2000, the company was booming because all these assets kept getting larger and larger. We would have like omelet breakfasts every day and, free drinks and everything. And then, wow. Then it tanked and pretty soon everybody's miserable and then you're not even allowed to be happy and no more free drinks. And so it was all new to me at the time, but that was an interesting introduction to to the business side of it.
Yeah, it's such a fascinating cycle, and just that image of at the top the excesses, like you said, the omelet breakfasts and all the excessive pleasures, I guess you could say. Because again, you always hear those quotes about the euphoria at the top. And, a lot of us, ever since 2000 and 2008 especially, so many of us are just paranoid, waiting for it to happen again. And it's helpful to remember, not that euphoria necessarily has to preclude a stock crash by any means, but it's helpful to remember that's what they mean by euphoria. It's that kind of excesses and stuff. And that's a great picture.
And that's a good point you make, because people are so scared about the valuations now. But if you were there for 2000 and 2007, 2008, this is not what a top looks like. When it's a top, everybody's sure it's going to keep going, and everybody's going long, and that's a top. This is everybody's terrified, and we're climbing a wall of worry. This does not at all look like a top to me.
Yeah, it's such a struggle. And I talk about this weekly with guests. Right now you look at market fundamentals, you look at market valuations, and by any historical standard, the market as a whole is very overvalued right now. And you can look at globally, you can look domestically and easily find, 20, 25, 50 different things you can look to be worried about. Like you said, that this is a concern or whatever it may be. And yet here we are. Markets recently hit new all-time highs. And for those listening, this is late July 2016, and people are just embracing for that to happen, and it's not happening. And it's it's funny for the people like me that sort of got involved with seeking alpha after the 2007, 2008, 2009 crash. Coming in then, I mean, it was fear, and that fear has never stopped for the last 7 years. It's that we've climbed a wall of worry for 7 years. There hasn't really been, in my opinion, euphoria over the last 7 years, and we've just had doubt.
Market.
Yeah, no doubt. I know, I would agree. But it would be fascinating to continue to take that perspective back further and further historically, following other stock market crashes, and because it seems as though the aftermath of the two. One, you weren't on Seeking Alpha then, but you were involved, someone in the industry. The aftermath of the 2000 or the tech bubble in around 2000, it didn't seem like it took people very long to get over that. I mean, obviously accounts had to recover, but psychologically, it didn't seem like it took too long. But the second one in that 1 decade was been really traumatic.
Agreed. That's when people were really fearful to go back in, and that's too bad, because that was quite an opportunity.
So right now, with the markets being overvalued, with the markets
being overvalued,
historically over, exactly. And again, I personally, obviously everyone needs to make their own decisions, and I think that ultimately, and I assume you agree with this as well, that we should make our decisions based upon market fundamentals and be careful of trying to gauge timing too much, because the longer we try to do that, the more we're going to end up being wrong, because it's just no one does it perfectly every time.
That's right.
That being said, it definitely seems like the path of least resistance is up right now. It is, and I kind of hear you saying the same thing. Is that true?
That is my opinion, because I think the number one thing, rather than historic valuations as far as what's a good value, it's what else is there, and the money has to go somewhere. There's a lot of a lot of dollars that belong to very wealthy people out there, and they can't spend those dollars. They have to go to bonds, and when bonds are not even keeping up with inflation, what is left but the stock market? And the bonds are the payout for bonds, near all-time lows, but we haven't gotten there with stocks yet. So I think there's plenty of room for stock. In fact, there's a good gap there as far as stocks have a way to go to catch up to bonds, and there's really nowhere else for the money to go. That's my general feeling, and that's why I'm bullish.
Well, and then there's not even factoring in the central bank action, what they may or may not be doing in terms of pumping more money into the system and continuing to, trying to ensure the markets stay positive. Excuse me, and you can get into obviously all kinds of political things as far as whether or not there's incentive to do that during an election year and so on. But all that aside, it definitely, I'm with you. I think I still want to have a fundamental mindset and not get too, not careless, but too loose with the money in light of, market valuations. But, that's kind of what I expect. I think historically speaking, what I expect to play out is that, we'll have this wall of worry, and then we'll have another big surge up, 15, 20%, maybe even from current levels.
Right.
And probably right when people start getting comfortable, that's probably right when it'll be time to get cautious and scared again.
Exactly. And there was just a really good article on Seeking Alpha about that. Can you afford to miss the surges? Because the gains come in fits and starts. And if you're waiting for the market to turn, it's going to be too late. And so trying to time the broad market is there's just way too many variables. And historically, the gains have come in fits and starts. So you just got to be long if you're going to go long the market. You just got to be long instead of trying to time it.
Well, and there's a couple things of that I think is really helpful. Is first of all, what do you mean by market timing? Because some people, does that mean, hey, I think a crash is coming, I'm completely pulling out, or because there's a whole range of responses that can come when someone thinks the market may be too high and there could be some ominous action on its way. It could be as simple as going, well, I'm 20% cash. Well, if someone goes 20% cash, it's not a dramatic move. You know what I mean? But if someone goes 50% cash, well, then you're definitely, you're going to miss out on a big market move up and stuff. And so those are all a whole nother conversation. So I'm curious, if you were in a scenario where you feel like things were really frothy, do you know how you'd respond?
Yes. Historically, and this is coming from Bruce Greenwald, historically, even when things are frothy, that does not give you an indication of what's going to happen in the short term. And historically, when things are frothy, what's better than going to cash is going to part cash and part stocks. And like you said, the 50-50, I think the 50-50 is a great option for a lot of people, because if you have the right psychology, you don't know what's going to happen. And if you have the right psychology and a long term, first of all, you have to have a long term outlook to be in stocks at all. And then psychology has a lot to do with it, because if you're going to be too scared, you're not going to see through any strategy. And so that 50-50 strategy, you can say to yourself, if like 50 cash, 50 stocks, and if the market goes up, you made money. And if the market goes down, you can say, I'm smart. Everybody else was in the market. I took out half and I get to buy in lower. So as long as you have a good mindset, I think that for the people that are afraid to go in, I think 50-50, when the market is frothy, when they feel like that, I think instead of cash, I think a 50-50 is a better bet.
Yeah, it's definitely balancing things out a little bit more. And there's also two things to keep in mind too, that people, if there were, and again, I don't want to focus all of our time on a market crash type scenario, even though it is interesting to talk about. There's two parts of that. One, you want to preserve capital. Obviously, you want to prevent as much loss as possible, which speaks for itself. But you want to have money available to buy when things are at the bottom, which is honestly, I think, just as significant as not wanting to lose money. And with your either 50-50 approach, it kind of helps with that. And I would almost think that having a higher level cash allocation, whatever that may be, the bigger value in that is not that you're not losing money on it, but that you have it available to buy when it is low. And again, that may be splitting hairs, but I like to think of it that way too.
And then especially today, and because the opportunity cost is lower, if you're not in bonds, instead of missing out on the 10% rates of the past, you're missing out on 1.5.
Right.
So the opportunity cost is sitting in cash. And then people should remember too, if you're going to sit in cash, you can get a return in money markets. There's CDs if you're looking for the highest guaranteed return. And then there's also CDs that let you cash out early. You're not going to get as good a return, but if you are going to sit in cash, you still can get a bit of a return that's somewhat comparable to bonds. And then you can, when the timing's right, you can go in, go back to equities. I feel the same way about gold. I'm not really a gold bug, but it's pretty useless to have it unless you're willing to sell it after you got it right. If the market crashes and gold goes up, you have to be willing to sell your gold and switch over. Then gold's a good asset to be diversifying with. So I feel like cash and gold are the same in that respect.
Nice. Well, yeah. Again, it all depends on your time frame and what you see the next opportunity to be. And a lot of our conversation. Most of our conversations on this show focus on equities for good reason. That's usually the most accessible investment for most people. And via equities, you can access almost any kind of sector or market out there. So there's a lot of reasons why there's benefits to it. Yeah. But there's, you can zoom out even more in the asset universe. You've already mentioned bonds, obviously, stocks, bonds. You mentioned gold and different kinds of assets out there you can invest in. And so depending on what someone's thesis is, when to roll in and out of one versus the other would help guide some of those decisions. So I think that's I appreciate you bringing that up.
Sure.
So backing off from stock market crashes for a moment, I would love to hear more about your philosophy of investing and your approach.
Wow, it's really, I feel like I'm lucky that I found something I enjoy doing. And I feel like a lot of the people in finance feel that same way. This is a fascinating thing. This is not data entry. And I really, my research or my method is really what interests me. And whatever it is that's fun to be researching, or that I think might possibly have an exciting, if you research it further, it might actually turn out to be an exciting opportunity. I think if I could give new people that are new to the stock market any piece of advice, it would be to focus on the already profitable smaller companies. You exclude people like Warren Buffett that are picking through those companies. All of the most successful investors are excluded as your competition because they have too much money to be buying these smaller stocks. And then the small home run grand slam stocks are terrific. I like those too. But I think the new investors would do best if they only looked at profitable small companies. That's a terrific, talking about maybe less than $1 billion in market cap, but already a successful business. I think that's a great universe for investors to start with. And just like Warren Buffett said, he'd rather be hunting mosquitoes, but he has to hunt elephants. And while you're not a billionaire, it's an advantage, and you should take advantage of not being a billionaire. And people that they've heard of Google or Alphabet or Microsoft. They like the names they've heard of, and that's great. But look at the $400 million stocks or the $70 million stocks, and the ones that are already profitable. You don't need some event to happen to make a huge score. These are just where the values are, and I think that's the first thing I like to do is to stay in that smaller cap universe or even micro cap.
And so one thing, just to kind of summarize that a little bit, is the benefits of the small cap investing world is that you have a lot less competition out there. There's most of the analysts, most of the big institutions, big investors like Warren Buffett have too much money to invest in those size companies, because if they were to invest in a small cap company, they'd basically be buying it outright, which is not what
and
they're
even
trying to do.
Even if they bought 100% of it, that would impact their bottom line far less than 1%.
Exactly.
So, yeah, and so the success this is what Joel Greenblatt says as well, is that in some senses this game has gotten harder because there's so many more people that can do the research and all these things. But in another sense, the successful people move up the food chain, and you're in the minor leagues here, and the competition is not as tough in the smaller stocks because the most successful people can't compete with you.
Right. And when you just differentiate between, in the small cap stock world, one of the ideas too with smaller companies is there tends to be high level of risk because they don't have the company size to absorb different kinds of blows or setbacks, generally speaking.
Yeah.
And so focusing on companies that are already profitable means within the small cap world, you're focusing on companies that have a lot higher likelihood of success versus, like you mentioned, the small home run stocks, which are great, but those are usually a little more risk as well.
Absolutely, yeah. And that's one thing Joel Greenblatt said, is that everybody likes those small home run stocks, and you can get it right. You can, in the smaller ones, you can get a research advantage because, again, those very successful investors are not there, and especially in the more complicated smaller names. They're every day you look at the stocks that have moved the most that day. There's always some small company hit a home run that day, and so those moves are out there, and you can find them. But in the beginning, you'd probably do better to stick to the profitable companies first.
Great. So once you're in that space and once you identify, so once you're there, apart from looking for companies that are already profitable, what other things do you look for when you're filtering through?
Well, I like starting in the sectors that are beaten down, because there is sector rotation, and that there's another great thing that I feel like people can take advantage of. Sectors rotate, and so right now I still like utilities because I just feel like rates are going to stay low. So I don't hate utilities, but they've been darlings. And then if you look at finances and healthcare, they've not been darlings. And they talk about two sectors that are going to be around forever. As long as there's capitalism, financial services are going to be there. And as long as there's people, healthcare is going to be there. There's two terrific long-term buys. And they're both, especially in healthcare, the pharmaceuticals, and especially in financial services, I like the insurers. And so I'm looking at this, if you take a look at what sectors are out of favor, look at the profitable companies in there, there's a great place to start.
Awesome. I like that. Again, I say this a lot, but whenever I find someone who has a process for approaching their investments, it gets me excited because I think it's just so important to do that. So you're looking at small caps, looking primarily at small cap companies that are already profitable, and then looking at beaten down sectors right now. That would be primarily finances, healthcare, and even more specifically, insurers and pharmaceuticals. And then, so as you're narrowing like that, I guess at that point, you look at the companies within those sectors who are profitable, and then you start, how do you research companies at that point?
Well, a lot of it has to do with self-education at that point. Once you find a subsector that you like and you think is out of favor and it starts to be intriguing, you learn that there's a number of things that go into that particular. There's a number of metrics that are important for that sector. There's a number of metrics that are not important. There's even different ways of accounting. There's different accounting is actually done a little bit different in the tech industry and some of the others. So once you pick your subsector that's been a little beaten down and you think is interesting, for me, even though I feel like I feel like I'm a very knowledgeable person, I still every time I do investigation in any one particular stock, I learn more about their industry and their sector. And so that's one of the most fun things about it for me. I love to learn, especially about finance. And so for me, a part of the process of selecting a stock is always a little bit of self-education about the market along the way, even if I feel like I knew it beforehand.
Sure. Yeah. And so tell me, what is that? So what kind of resources do you primarily look to for that self-education?
Well, I used to teach software classes, and a lot of times I got a good reputation as being a good teacher, and I would teach 2 and 3 day classes in the DC area, Washington, DC. And so like a company or a lot of the government agencies, what happen, they would buy software and I would go in and teach it. And I got a good reputation as a teacher, and I started getting hired to do things, to teach software that I had literally never heard of. And and it's like, well, next week you got to be an expert. And so it's like, okay, I got to do that. And I just, at that time in my life, I felt like I got really good at researching online. And I wouldn't necessarily, so just going to Google and typing in a good search phrase, for me, that a lot of people feel comfortable doing that. I feel comfortable doing that. And so that's where I start. I don't necessarily, there are definitely some sources that are better than others. You don't want to go to the UK Mirror or whatever, Daily Mail or whatever. And if you can, most especially if you're in the healthcare sector, you definitely want to get comfortable going to understanding the studies, the trials, and being able to read that, the conclusions, the abstracts, and those are, especially when you get into healthcare, that you start learning. I mean, there is a very reliable source. That's not somebody's opinion. Here's some hard science and hard data. So, and then the primary sources. A lot of people, when they start out, it's nice to go to Seeking Alpha and read somebody's summation of their view of a company, and that's fine. But go to the primary sources first. You absolutely have to check out the most recent quarterly and the most recent annual report. That goes without saying. And then people should also, especially new people, they should get familiar with some of the more important filings. So the 10Q, there's your quarterly reports. You got to look at what's going on lately. The 10K, that's your annual report. A lot more information in that report. And then 8Ks, a lot of people don't know what an 8K is. You always got to check those out. And so when a material event happens, they'll report it in their quarterly report, or they'll report it in their annual report. But if a material event happens and they're not about to report, and they want people to know, they're not about to report a quarter or a year and they want to put it out there, they'll do an 8K. And so that's, again, material information. So you always want to check out the latest 10Q, latest 10K, and the latest 8K. And then one more I'll say that I would encourage people, especially in the smaller stocks, to be looking at is the number 4 filings. So the Form 4 is the insider buying and selling. And especially in the smaller companies, I really feel like that really does give you an advantage. There's not many times you see a lot of real insider buying and then the company tanks in a small company. And more often, people do sell out for all kinds of reasons. So that doesn't necessarily mean anything. But when you have real buying with people's personal money in a small stock, that's a pretty darn good indication that you found something good. So those 4 filings, the primary sources, as you're researching, you want to go to the primary sources. Second best will be things like the healthcare trials, the drug trials, those studies where there's no. This is So with those types of sources of information, there's no opinion. You want to keep the opinion as your opinion, not incorporate other people's opinions. Keep it strictly to the facts. And that for new people like getting secondary sources. They like getting the summation on Seeking Alpha, and that's fine. But you have to go to the primary sources.
Right. Well, I mean, the more you remove from the original, the more you're allowing for more human error to take place.
Absolutely.
So tell me, when you're looking into the primary resources, and I'm really glad you mentioned those because I fully agree with you. Are there certain things you're looking for when you approach those documents, or is it I'm here to like blaze through this entire annual report and consume all of it? Or, I mean, or do you have like 2 or 3 numbers you're aiming for? What does that look like?
Well, it depends on the sector. There are definitely things I'm looking for. It depends on the type of business. But I found out pretty early that it was pretty shocking to me when I first started seeing this. If you read the conference calls, and there's another one, there's another primary source. You're getting it from the horse's mouth. The CEO or the VP or whomever is telling you this is our view. So again, you have to read the conference calls. So there's another very important one. But it was pretty shocking to me what a stark difference in tone there is between the conference calls and the filings. On the conference calls, these people are going to make their companies sound good, and it's their jobs. And if they go out and trash, if they say, I don't think we're going to do too well there, then their stock price is going to take a hit. So they can't do that. But if you want to hear about all the bad things that might happen, it is in the filings. That's where these guys cover their rear ends. These people cover their rear ends. And they will tell you every single thing that can possibly go wrong with the company. And so it's a pretty stark difference to read the cheery outlook in every conference call and then to have them say, in order to cover our rear ends legally, we have to tell you about everything that can go wrong. I think for a lot of new people, they might find that a pretty jarring, that have never read the filings before. I think and that have read the transcripts. I think the contrast there, for me, that was pretty stark. Because it's like, no. I just heard the CEO just say that's not going to be a problem. But then in the filings, like, this could be a problem that destroys our company.
Right. It's like the fine print for like your new iTunes agreement. Everyone just skips past it because you don't really care. But, it's worth noting, especially in sectors like healthcare and, oil and gas and some of those different things. There's just so many things that can go wrong. And again, some of them, like you said, are there because they're trying to cover themselves from, legal ramifications. Mm-hmm. And so some of them may not be a high level risk, but it's still good to be aware of a lot of that stuff. What else? What other kind of things do you like to look for?
In the filings?
Correct.
Let's see. It depends on the sector. Right now, I am writing one up on the insurers. And so I like to look at the last quarter over the year before quarter, the last year over the year before year, and then go back farther as well. So it's like, okay, you've had good growth this quarter, you had good growth last year. So then I like to take a look farther back in time. And you never ever want to just go by the numbers. A lot of people just look at the charts, and that's fine. But so if they had a big down year, a big up year, you want to see what happened there. There's one-time events, maybe management changed or the strategy changed since the past. But you want to get a picture of where this company has come from. Management is, I wouldn't necessarily say that's in the filings something that I'm looking for, but in general, something very important, management. We can talk about that next. Sticking to the filings, like on the insurers, I'm looking for in each sector, there's going to be some key metrics. So for the insurers, I'm looking at the net earned premiums growth and the combined ratio. So net earned premiums growth, are they writing more and more business? And then the combined ratio, is the business that they're writing making money, or are they losing money? And so if you can find a company that's growing while writing good business, there's a great one. So you have to be familiar with what metrics are important in each sector and then find those in the filings. And then the risks as well. And they even, most of them just have a sector, like here, a section of the filings. Here are all the risks. And so that's really important because you never know. They could have some lawsuit that they never talk about on the conference calls. They could have some patent expiring. And so they really spell it all out there on the filing. So that's important. So it really is tedious to read every word. But the longer I'm in the game, the more I realize they don't waste their time. If they put something in the filings, you should be reading it.
That's a good word.
Yeah.
Well, of course, that brings up another question or maybe it's more of a point, the time that investing well takes. And this is one of the things that I like to reinforce for our audience a lot, is not to discourage people from investing on their own, but to make sure our expectations are realistic in terms of how much time it takes an individual to really vet and do the proper due diligence that I think is warranted before buying a stock if they're doing it from scratch. Obviously you can pay for research to speed that process up a little bit, or maybe you can have some of your money in passive indexes so you're not having to come up with leads for your entire portfolio. But for those ones that you are, it's a big task.
It is a big task. And that's where I'll go back to. There's some people that really enjoy this. And
right.
Yep. And so if this is what you're doing because you think it's fun, now you've got a big advantage. And so you're going to eventually, put the time in to figure out what these companies are doing. And it's a fun game. And if you don't think it's fun, maybe you should, spend your time doing something you think is fun.
Well, tell me this, in light of all these resources that you're pouring through, at what point do you know you're ready that you like the stock? Is there something that happens and you're like, okay, this is it, I've got what I need? Or is it just every time?
I would say that the big thing for me is their valuation relative to every other company in the sector. If you can find a good stock on the metrics, there happens to be an insurer I really like now. I told my subscribers about it, and it's a small company. It's less than 100 million in market cap. But if you look at their net earned premiums growth, if you look at their combined ratio, and then compare those to the industry, these are some of the best metrics. This company does some of the best underwriting, and they're growing as fast or faster than just about anybody. So it's like, and then from there, that's like the two things I'm looking at. Okay, so what is the valuation, and what am I missing? Why is this company on sale just for me?
Good question. Good question.
Yeah. So a lot of times, if you are in the micro cap or small cap world, the answer might be because nobody bothered to like this. So this company I'm talking about is Kingstone Insurance Company, KINS, and they were a mutual insurance company until 2009, meaning they were a not-for-profit company. So nobody knew them, and they're not even $100 million market cap company yet. And there's just I've never met anybody that's heard of them, and so that's a good reason why they might be. There are small cap stocks like that are just values because nobody's really known about them. There's no way this company could have the best, some of the best growth and some of the best underwriting as a big cap, large cap company and not be known about it. This company trades for less than 10 times earnings. And if it was $100 billion company, there's just no way that would go unnoticed. It would be, yeah. And right. So that's a really good reason to stay in the small and micro cap space, and especially because those opportunities are there. And then especially if you stay with the profitable companies, you can also cut out a lot of the junk. You're going to cut out some of the stocks with a huge upside as well, but you can really make yourself a lot safer sticking with the profitables. So I would say relative to the other companies, looking at the metrics, so how do they stack up? And then the valuation, how does it stack up if the business is good? And then what am I missing? And then hopefully the answer is nobody knows about it. That's what you're missing, hopefully.
Absolutely. Well, Joe, this has been great. I'm really enjoying your process, and it's funny, I'm looking at the clock and I can't believe we've already toward the end of the interview because I feel like we're just getting warmed up. Before we wrap things up, do you as our audience is listening, are there any kinds of any last wisdom or insights you'd want to pass on to our listeners, knowing that most of them are probably maybe in the beginner level, or at the very least are definitely self-directed investors?
Well, I would say I'll use this for a chance for self-promotion. Coming from the teaching world, I've tried to I've sort of had the person who's not very familiar with the stock market in mind as I write my articles. So even when I'm doing sort of a high level analysis, I like to I like to make it accessible, hopefully, even for people that are not that familiar with the stock market. So I try to not to take too much for granted as far as someone's knowledge, and I don't try to underestimate people's intelligence. So the view of, you are smart, but you don't have this knowledge is what I go with. And I try to, and so in all my analysis, I try to make it accessible for people that aren't very familiar with the stock market. So I've written 135 articles. So if you go to Seeking Alpha to do a little self-promotion there, in my opinion, I do have a number of things I'd like to tell people, but I've written them. And so you can read my stuff there on Seeking Alpha. Stay small, because until you're a billionaire, that is a real advantage that you have. And if you like it, then you're really lucky, and then you can pursue it. And then I would agree with Warren Buffett that either you really like it and you can spend your time that way, and now you can stay in the small caps and get an advantage, or diversify the heck out of your portfolio and don't lose sleep. And so, like I've recommended 5 ETFs. If you are I like active investing, but if you are a passive investor, I wrote an article recently. What I think is the best retirement strategy: a CD ladder and an American equity portfolio. And so if you read that, you can see that if you are a passive investor, there's 5 ETFs in there. You can take advantage of market anomalies. So if you are going to diversify, either you're someone that really enjoys it, and then I encourage you to use that to your advantage, to get in those small cap profitable companies and do some research, or you're a passive investor, and then I would encourage you not to just sit in the S&P 500, which is fine, but there are real market anomalies out there. And again, there are good ETFs to take advantage of these. And again, they are not huge. They don't have a lot of assets under management. So these are not $100 billion companies that Warren Buffett, or $100 billion ETFs that Warren Buffett could buy a piece of if he wanted. But there are ETFs that take advantage of market anomalies, such as low volatility and momentum, small cap outperformance, which actually has to do with low volatility again. And so I would say if you are one of these passionate people, use that to your advantage and start researching the small profitable companies. If you're not, completely diversify and stick to a schedule so you can take your emotions out of it. Maybe on your birthday every year is when you rebalance your funds, or on July 4th or whatever it is, July 1st or whatever. And so I would encourage people to, if they are going to diversify, try to take advantage of those market anomalies. And you can see those ETFs I recommend. But it's the same thing again. Those anomalies are real, and these ETFs do a good job. But again, the big players can't take advantage of that. So even if you are going to index, you don't have to get the returns that Warren Buffett are getting. You can probably beat by about 4% a year over a long time frame.
Well, hey, Joe, thanks so much for joining us today. Have a great rest of the afternoon.
Brian, I really appreciate it. Thank you.
I hope you enjoyed the interview with Joe Springer. Remember, you can get full show notes with the links and other details at investorinthefamily.com. And for everyone who applied for the Intelligent Investor Reading Club, I will have results back to you soon. Thank you so much to everyone who did that. And remember, support the show by, when you shop at Amazon, go to investorinthefamily.com/Amazon, and a portion of everything you buy will come back to us as a way of saying thank you at no extra cost to you at all. Thank you so much in advance. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.